Good afternoon, everyone. My name is Michael Naidrich, and I am the co-CEO of Amerivet Securities. And as always, I am joined by my partner, all things CFA, rates, and the Fed, Gregory Faranello. Hey, Greg, how you doing, buddy?
How are you, Michael? Good afternoon.
I am doing well, bud. To say this is a big week for a variety of reasons would probably be the biggest understatement in the 5 years or plus we've been doing this. But there's a lot going on, and I think in the enthusiasm for this election. People are forgetting there's a pretty big Fed meeting this week. So I think I'd like to start maybe by just, jumping into the Fed a little bit, and then maybe we'll wrap it up with a little bit of some of the things I'm seeing out, with our clients, and then maybe sort of what the election may mean one way or the other, depending on who gets elected, and maybe even down the ticket might be more important. So always appreciate your time. Hope you had a wonderful weekend, and let's jump into it. Greg, let's just go global. Give me a preview of the meeting, what you think the decision is going to make, and maybe some of the themes we might see in Chairman Powell's presser.
Sure. No, thanks, Mike. Yeah, I mean, clearly an interesting week here with the election and the Fed meeting. The election short term is going to have no bearing on the outcome of Thursday in the Fed. It's pushed back a day because of the election. We're priced for 25. The Fed is likely going to deliver a 25 basis point rate cut following the 50 basis point rate cut in September. We don't expect much to change in terms of the statements, and then it's gonna go right to Powell's presser. The theme really in between meetings to us over time is better economic data since the 50 basis point rate cut, and that has lent itself to the Fed coming out with this notion of gradualism, being a little bit more cautious. Moving forward, trajectory still the way it's been headed toward a lower rate path, but a slower rate path, and then even potentially meeting to meeting, we could see a pause. We could certainly see a pause in December, although that's not a given, depending on the data. So we do think Chair Powell is going to be questioned a little bit about this 50 basis point cut, why the jumbo rate cut, and coincidentally, just as we got that rate cut in September, the data all turned even more positive. So definitely some questions around that, but I do think it will be a slightly hawkish easing for the Fed. And I do expect Chair Powell to retain optionality going forward in terms of what comes next.
That makes perfect sense. So Greg, maybe you could help, folks like myself who are not as sophisticated as you are, and just talk about the repricing and the rates. If the Fed is allegedly potentially cutting or even staying, pat, why are rates higher?
Yeah, look, I mean, it's a good question. I think from our meetings, I mean, it's the number one question I get from issuers and investors. The Fed cut interest rates, why are rates higher? So I'm going to run through some rapid fire here with some bullet points in terms of what I think. I mean, first and foremost, I think the market was ahead of itself heading into that September meeting. So if you look at even that September rate cut, at one point we were priced for 75 basis points. And then if you look at SOFR, which is, tracks the Fed funds rate very closely with the spread out to 2025. At one point, that rate was implying a 280 Fed funds rate a year from now, right? That's backed up in yield, for context, 80 basis points from that 280 level. So the market was a little ahead of itself. The pandemic, I mean, we've shifted from demand side issues to supply side issues. That's in the back of everyone's mind. The rate of change of inflation has come down, but I think that is still out there, depending on how the election goes and how policy transpires. Now, also, too, the balance sheet, right? The Fed is still running off their balance sheet. So unlike other easing cycles where they were expanding their balance sheet, they're running off their balance sheet. We still have a lot of treasury supply. The buyers, in terms of these auctions, are much more price sensitive than what we're used to seeing. So, when the Fed's buying, they're not price sensitive. When foreign central banks are buying, not so much price sensitive, but now you have the domestic account base picking up some of that slack in terms of issuance and buying, and also foreign investors also much more price sensitive. So that's sort of lent itself through the auction process for rates to back up. Certainly the election, there's been Trump fever. I think over the last month to month and a half, we've seen that in the rate structure. Term premium has widened out. And then, look, the bottom line, last but not least, the economic data has just been better than expected. The city surprise index bottomed in September. We'll get an ISM services number tomorrow. Last month, that's where 10-year yields bottomed in and around 380. So the better economic data has shifted too. We see the split roughly between some of the Trump enthusiasm, which we're unwinding a little bit today, and the economic data. We see it 60% economic data, 40% potential election outcomes in terms of the rate move that we've seen, certainly further out the curve from 380 to call it 435 in 10-year space. So I don't think it's one particular thing, but hopefully that offers a little bit of a summary.
Yeah, that's a lot of color there, and appreciate it. It's a challenging conversation because you're right. It's not just one data point you point to for sure. So, as you know, I've been on the road quite a bit here lately, and I think I'm still going to be on the road quite a bit here in the next 3 or 4 weeks. And I've been talking to a lot of clients. So I just kind of want to give you some thoughts of what I heard and just sort of get your thoughts on it. I think, just looking at the overall calendar, October was a lot slower than the months previously. I think November will be a little challenging because you have the election, which could have some, we might not know Tuesday night, or we might not know for a couple of weeks. Hopefully not. And then you got some, you got the holidays with Veterans Day, and let's make sure we wish all our veterans our gratitude and happy Veterans Day, especially the ones that work for us, right? And then you got the Thanksgiving holiday. So I think a lot of the clients had pre-funded a lot, knowing that this time of year was going to be a little bit challenging. I do think you'll see some pickup in the middle of the month because it has been some slow. But I think, what I think I'm hearing is, if you ask, and we had this conversation, I think back in March, a lot of syndicate desks were saying, God, it's so easy to price these things, and the demand is so crazy, and some of these things are 4 and 5 and 6x. And I think there's still examples of that in the issuances. But I think there's some issuances now that are, I saw one last week where, I think they wanted to go out at $1 billion, and they did 500 million. And I think they found out the belly of the curve was where more of the interest was, and they did another 500 the second day based off of what they learned. So I guess my point is, not everything is easy as it once was here in the debt markets, and people are starting to at least take a pause and look a little further than just sort of the easy money. So thoughts on that, please.
Yeah, I mean, look, in terms of the curve, I think that makes perfect sense. I mean, we've seen the curve steepen out a little bit in Treasury space. We still love the 5-year and under part of the curve. I think you're seeing this volatility. We know there's going to be a lot of issuance in the market. We finished fiscal year 2024 with a $1.8 trillion deficit. I think, irregardless of who wins the election, I'm hearing at least a theme of more spending going forward. So, so the long end is a little trickier, but certainly 5 years and under from an issuance perspective, I think makes a lot of sense. You go even further in the curve, CP, CDs, even money market accounts right now. We know the Fed's going to continue to come down, so there is some reinvestment risk. But yeah, I mean, from an issuing perspective, I think that 5-year and under part of the curve makes a ton of sense.
Yeah, I think so also. So let's get to the election. And, I think that, look, this is probably as heated as an election as I've ever seen. I'm 54 now. I think what I want to focus on here is not so much, who's going to win and why, but maybe more what it means if there's a Republican win, what it means if there's a Democrat win, and maybe if you can even drill down to, if it's split, right? If one wins the presidency, but down, in the House or Congress, it looks a little different on the Senate, excuse me, what you think, and what do you think maybe be the best possible outcome for the country? And I don't mean which side, I'm meaning more like, how it all shakes out, if you understand what I'm trying to say.
Sure. I mean, for me personally, I think gridlock is probably the best outcome for the country, and probably the best outcome for the markets. I mean, for the country, I mean, and maybe it applies to both. I mean, look, we're if you look at the history of the country, we're 250 years old, call it. Up until 2000, we had roughly 6 trillion in debt. From 2000 to 2024, we have 35 trillion in debt now between public and private accounts. 40% of that debt increase was from 2020 to where we are now. So we're just on this unsustainable path. So I think a little bit of gridlock, if Washington and Congress, I mean, if they still have the will to spend, which it seems they do, I think a little gridlock would not only be good for the country, but also good for markets. So, in terms of outcome, I mean, look, Congress, I think, is going to be a coin toss. I mean, that seems to be the consensus. It seems to be some sort of consensus that the Republicans could retain the Senate. If you go onto that premise in that scenario, then we've got, Vice President Harris, we got former President Trump. This morning we walked in, this is more of a Vice President Harris trade. So we're unwinding some of the steepening and higher rate scenario from Friday. And then if former President Trump takes it and has maybe the Senate with him and the House is a coin toss, maybe we flip back the other way, rates go a little bit higher and steeper.
Yeah, it's going to be wild. I know you'll not only be watching the presser. I know tomorrow night we'll probably be texting to wee hours in the morning based on some of the results. I think what I love about you the most is not only the work you put in, on the rate side for us and our clients, but I know that you're just a proud American and you'll support, whoever's our president moving forward. And I think that's important. So, Greg, I love this. This is a big week. Maybe actually we'll come back next week with a little post-presidential election analysis and see sort of where we shake out. Maybe that's a good idea to do for our clients. But great weekend, bud. And if any of our clients are looking to sort of unscramble some of this chaos that we're going to walk into here the next week, please reach out to your AmeriVet representative and we'll get Greg on the phone with you right away. Thanks, Greg. I appreciate you, man.
Thank you, Mike.